Welcome to Unit 11, Adjusting the Books. The objectives of Unit 11 are as follows. Upon completion of this unit, students will be able to demonstrate the skills necessary to do the following. Explain why adjustments are necessary. Prepare adjusting entries for prepaid expenses. Prepare adjusting entries to record depreciation. Calculate depreciation using the declining balance method. Describe the principle of materiality. Describe the principle of conservatism. We have learned about the accounting cycle in the previous 10 units. In this chapter, Chapter 6, which includes Units 11, 12, and 13, we will be learning about the accounting procedures that are prepared at the end of the accounting cycle. These procedures include adjustments, new financial statements, and closing the books. To begin learning about adjustments, we will take a look at case study number 2. This can be found in your textbook on page 265. When we read case study 2, we can see that the balance in the supplies account is $1,500. However, the actual value of supplies after an inventory has been done is only $200. We see that the net income is $22,000 for this accounting period, and the total assets are worth $110,000. However, adjustments have not been completed. What we need to know and what we need to ask ourselves is the net income the same? Is it overstated or is it understated? Are the assets the same, overstated or understated? And finally, we need to determine the value of the net income and the assets once the adjustments have been done. In the supplies account, the supplies have been consumed during the accounting period. We started the accounting period with supplies valued at $1,500. During the accounting period, we've used up the supplies and there's only $200 worth of supplies remaining. This means that we've used up $1,300 worth of supplies. The journal entry for this kind of transaction is December 31st, which is the month end or the end of the accounting period. We have a supplies expense, which is a debit amount of $1,300. Our credit entry is the supplies asset account of $1,300, which is credited. The description for this transaction is to adjust the supplies account and to record the supplies expense for that month. What happens to the net income? Originally, we saw the previous net income was $22,000. However, we now have a supplies expense that must be included, and it is $1,300. Therefore, the adjusted net income is $22,000 minus $1,300, which gives us a real net income or an adjusted net income of $20,700. What happens to the assets? In the beginning, the assets were worth $110,000. But now that we've adjusted the supplies account with a value of $1,300, that means that the assets are worth $110,000 minus the $1,300, which will give us an adjusted value in our total assets of $108,700. So, let's go back to the original question. Is the net income the same, overstated, or understated? It's overstated in this example by $1,300 because we have not done the adjustments. Are the assets the same, overstated, or understated? Well, we found that the assets were also overstated by $1,300. And finally, what is the value of the net income and the assets? We calculated those to be the net income of $20,700 and the value of the assets, $108,700. Now we're going to do exercise 1 from page 218 in your textbooks. Please open your workbooks to the corresponding page in the workbook. In this exercise, the supplies account had a balance of $700 at the beginning of the fiscal period. At the end of the fiscal period, an inventory shows supplies worth $100 on hand. On hand simply means that that's what's left. We are asked what is the value of the supplies used during the fiscal period. The value of the supplies used was the original amount of $700 minus the $100 that is still on hand or is still remaining, which gives us $600. This represents the amount of the supplies that were used during this accounting period. What is the supplies expense for the fiscal period? The supplies expense is $600, the amount that was consumed. What should the balance in the supplies account be at the end of the fiscal period? The balance in the supplies account should be $100. This represents the amount that is remaining. Now we must prepare the adjusting entry to record the supplies used. This entry has a debit amount of $600, and this is the supplies expense. Our credit amount is also $600, and this represents the supplies asset account. The description is to adjust the supplies account and to record the supplies expense for the month. What is the amount in the supplies expense that will appear on the income statement? The amount of the supplies expense on the income statement is $600. This represents the amount that was consumed during the accounting period. What is the value of the asset called supplies that will appear on the balance sheet? The amount of the asset supplies on the balance sheet is $100. This represents the amount that is remaining in the supplies account. Regarding adjustments, accountants cannot be satisfied to just simply have debits equal credits. We must be sure that the debits and credits are accurate, not just equal, but accurate, that the correct accounts have been included and the correct amounts have been included. Many transactions are active for more than one accounting period. They may start in one accounting period and they may end in another accounting period. The matching principle demands that revenue must be matched with expenses during the same accounting period. All asset, liability, and equity account balances must be accurate. Adjustments are accounting changes recorded to ensure that all account balances are correct. So we have to make sure in the supplies account example that we correctly include the amount of the supplies that were consumed during the accounting period. The purpose of adjusting the books is to ensure that financial statements are accurate, and that is the purpose that we have been striving for throughout our first 10 chapters. Adjusting the books. Prepaid expenses is a type of adjustment. Payments are made in advance for items such as rent, insurance, and supplies. Payments are often made in advance for a period longer than the accounting or fiscal period. Prepaid expenses are things of value, therefore they must be included. They are current assets. This is where we write prepaid expenses. They remain here until they are used up. They have no value at the moment. They become expenses later on. The amount used must be recorded in an appropriate expense account. At the end of the accounting period, entries are made to record the conversion of prepaid assets to expenses. The balance sheet account balances are corrected. The appropriate expense is recorded on the income statement, and these changes at the end of the accounting period are called adjusting the books. Let's look at prepaid rent as an example. Businesses sometimes pay their rent many months in advance. After each month has ended, adjustments must be made to record that 1 month of rent has been consumed. In the textbook on page 209 is an example. April, May, and June rents were paid in advance with a total amount of $5,100. At the end of April, an adjustment needs to be made to reflect that 1 month of rent has been consumed. This entry in our journal has a debit amount of $1,700, which is 1/3 of $5,100. This is the rent expense. Our credit amount is $1,700, and this is the prepaid rent. Now, because prepaid rent is an asset, the $1,700 credit will reduce the amount of this asset. The description is to record the rent expense for April. The amount remaining in the prepaid rent asset account is the $5,100 that we started with minus $1,700 for the month of April, which gives us $3,400 remaining in this asset account for the upcoming months. The income statement will show a new expense, rent expense, which has a value of $1,700. If the adjustments were not made, the expenses would be understated, the net income would be overstated, and the assets also would be overstated. Let's take a look at the supplies. This is also considered to be a prepaid expense. Businesses buy their supplies in advance, and they are consumed on a day-to-day basis. At the end of an accounting period, businesses perform inventory, where they count all the remaining supplies and give it a value. The supplies account must be adjusted. The value of the supplies used is transferred to the supplies expense account. The supplies asset account must be reduced by the amount of the supplies that were consumed. So in this example, the adjusting entry that we put in our journal is as follows. Supplies expense account is debited $100. The supplies asset account is credited $100. And the description is to adjust the supplies account and to record the supplies expense for April. Let's take a look at prepaid insurance. Most businesses and individuals purchase insurance on the building or their home for the assets in case of theft, fire, or damage. Insurance is normally purchased for the following year. After each month, an adjustment must be made to record that 1/12 of the insurance has been consumed. This amount is recorded as an insurance expense. The prepaid insurance asset account must be reduced by the same amount. The adjusting entry is as follows. There is an insurance expense that is debited $60, and the prepaid insurance account is credited $60. The description is to record 1 month's insurance expense. Your assignment is to read sections 1 and 2 from page 207 to 211. Complete questions 1 to 4 that you can do on paper, or if you go to our accounting website, you can answer the questions online. And complete exercise 2 in your workbook. The information in your exercise book, or your textbook, is on page 218.